Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews. Today we have Mike O'Kane, who's the head of Bullion at NZ Mint, here to talk about gold. We talk about gold about once a month. And Mike, welcome back. Tell us what's been happening with the price of gold in the last 6 weeks or so.
Okay, well, we finished 2010 off on a high. Gold broke through the 1420 barrier, so nominally a record high, a great way to end the year. Since then, what we've been seeing is a pullback. Most commentators are calling it a technical pullback. We're down about $80 an ounce at the moment, so down to $1,340 US an ounce. As normal, the Kiwi dollar movements locally meant that fluctuation is a lot less pronounced here, so we're sort of floating around the same point we have been, 1,800 spot market price for gold in New Zealand dollar terms. But the demand is actually increasing in the gold market for physical gold, and partly off the back of that drop in price. So obviously people are seeing it as a great time to get in because it's cheaper. Some are seeing it as a great time to get in because with the sell-off, because of the price decrease, there's more gold becoming available. But again, with what's going on in the macro economy globally, there's more flight to quality for gold.
Now, is this drop in the gold price because financial markets are more relaxed than they were, say, last year when the European debt crisis was at its worst? What's the fundamental reasoning for that more relaxed stance?
A lot of it is the move away from risk-backed or risk-averse investments, as the case gold is. So we've seen a lot of people moving back into the equities markets, back into the bonds markets. Essentially the news coming out of the United States primarily, which is overall pretty good considering what's going on, means that the market's softening for gold. Off the back of that, it's also nice to see a bit of a pullback. We have had our strongest growth in the gold price in about 6 years. Historically, the average has been $100 from January 1 to January 1 the next year. This is US dollar terms. This year, it was closer to $400 or $500. So a little bit of a pullback's to be expected, and to be honest, quite welcomed.
Now, looking at the underlying supply and demand for gold, what's changed out there in the last month, and what are you looking at for the next year or so?
We're starting to see we're starting to see a lot more demand for physical, both gold and silver in this case, as people are looking for tangible assets and more secure way of putting funds away. Also with the central bank gold agreements this year, we're still on target to have a complete total annual sale of 37 tonnes. Now, for the central bank gold agreements in its third iteration, we're on the 10th or 11th year. Average sale per year has been 400 to 500 tonnes, and we're at 37 tonnes.
And how quickly has it come down from that 400 or 500 tonnes?
Last year they hit the max. So it was 500 tonnes to pretty much zero. Also taking into account that of that 37 tonnes, 30 of it belongs to the IMF. So it's not actually the central bank selling it, it's the IMF. So on the whole, it's like all of the central banks have all of a sudden just turned off the spigot and said we're not selling anything. And if you look towards the BRIC nations, Brazil, Russia, India, China, they're actually wholesale buyers of gold and have been for the last 2 to 3 years.
So looking ahead for 2011, what are the things to look out for? If you're in the gold market, you're thinking about gold, what should you be focused on?
The key things I think will be supply and demand. So supply is getting tighter. It is taking longer for manufactured product to get to market. That doesn't necessarily mean that we're running out of gold itself. It's just it's taking longer to manufacture. Demand is... Was that supply or demand?
That was supply.
That was supply.
Yep.
Yeah, obviously demand is increasing, and we're seeing that at most levels, investment level, ETFs, exchange traded funds, central bank level. It is increasing across the board.
What about those useful things for gold, such as jewellery or electronics? What's demand doing there?
Depending on what happens in the macro market. So let's say the US market gets back to 80% of what it was 5 years ago, for example, and everything's back doing really well. Gold is used a lot in electronics, so we'd expect to see demand for gold pick up from that, from an industrial point of view. And industrial gold normally accounts for about 15% of its total use per annum anyway, so that's pretty good. Jewellery, we're seeing a little bit of a pullback in the jewellery demand, primarily because it's the largest market for jewellery in the world is India. And the Indians are quite a sensible nation and don't tend to buy when it's at a very high price. And in rupee pricing, it's at record highs. So the jewellery market in India has softened quite a bit. So it depends on what happens with the rupee price of gold as to whether that market surges again or stays where it is. At the moment, the expectation is it will probably stay where it is. Down from 75% of the global market down to sort of 60% at the moment for gold demand.
And what about supply of second-hand gold in jewellery back into the market? Because we've seen quite a few people set up these little shops and malls to buy gold jewellery when the price is high. What's that likely to do over the next year or two?
Well, if we take into account that 3 years ago, the second-hand supply of jewellery back into the market was literally infinitesimal. It wasn't measured. It now accounts for about 5% of the global supply. On a completely personal speculative point of view, I don't know how big that market is, but I can't see it continuing in that fashion forever and a day. I don't see it as a growth market.
Eventually people will run out of their spare jewellery.
Yeah. There's only so much jewellery in the back garden or in the back drawer in some cases. So that market, although robust and quite strong at the moment, I think will start to peter out. However, it's doing a good job of offsetting mine supply decreases. Prime example would be South Africa. It's down 15% supply year on year.
Why is that?
Their mines, they're not starting to dry up, but it's getting harder and harder to get gold out of the existing mines. So between their infrastructure issues, so lack of power to the mines for 6 months at one stage, they also have to dig deeper, so it's costing them more money to get the gold out of the mines. Even down to labour, the strikes they had last year went on for a few months, about 3 months worth of striking. So all of these things add up to a decrease in mine supply, especially South Africa being one of the biggest suppliers globally.
It's a bit surprising because the cost of mining gold is around about $900 an ounce, and with the price being over $1,300, you think people would be starting up new mines and building a supply that way?
Average lead time for a new mine from first shovel in the ground through to producing your first pure ounce of gold onto the market normally works out to be about 10 years. So we've had a lot of mines starting to come into the scene, especially in the Asian nations. China's a prime example, but there's no information out, so we don't know. But it normally takes about 10 years for a mine to come online. So that's going to happen as, even if we say we go back to 2005 when it became a viable option, still 3 to 4 years away before we start seeing anything in a wholesale fashion.
And just finally, looking at the relationship between the gold price and the silver price, there's been a lot of talk about silver in recent months. What's happening there in that relationship? And looking at the history of the relationship between gold and silver.
Demand for silver is increasing rapidly, and that's been seen around the world. The silver price has been sitting at nominal highs. We've seen $30 an ounce US. Doesn't quite equate to the $80+ we saw when the Bunker Hunt brothers went on their little rampage in the early 80s. But there's a lot of speculation that the silver price will pick up as the gold price does. A lot of people talk about the gold to silver ratio. Now, there's a lot of talk about that 15-to-1 ratio. However, if we take an average over 100 years, the ratio is closer to 50-to-1 than 15-to-1. So there's still a long way for silver to go before it gets anywhere near what people are expecting. Not to say that silver is a bad investment, but it's possibly not going to pay off as quickly as some people expect. And in the back of that, the silver demand is growing so rapidly that the supply has actually diminished quite significantly. We've got speculation that there's shorts going on in the market. Generally, these can be attributed to certain areas in the market where information's fed out. It's more beneficial to those feeding the information than it is to reality. So as with anything, a little bit of study before jumping in is probably a best option.
Grains of salt, useful thing in the gold and silver market.
Definitely.
There we have it, another of our double shot series, talking to Mike O'Kane from NZ Mint. Thank you very much, Mike, and we'll see you in another month's time for a special gold report. I'm Bernard Hickey for interest.co.nz.